What does it really mean to use leverage in trading? At its core, leverage allows you to control a larger position in the market than the actual money you have on hand. Think of it like borrowing a friend's car to take a road trip. You only have a bicycle, but your friend lets you use their car to reach that distant beach much faster. In trading, when you use leverage, you're borrowing money from your broker to increase the amount of capital you can trade with. For instance, if you have $1,000 and your broker offers you 10x leverage, you can control $10,000 worth of assets. It feels powerful, right? But here's the surprising part. That borrowing can amplify both your potential gains and your potential losses. Let's say you use that $10,000 to buy a stock that rises by 10%. You'd make a profit of $1,000, doubling your initial investment. However, if the stock drops by just 10%, you lose $1,000 too, wiping out all your initial capital. This is the double-edged sword of leverage. It can make your profits soar, but it can also sink you just as fast. Many people think leverage is just a smart way to maximize profits, but in reality, it introduces significant risk. Imagine that road trip. If you're not careful with your friend's car, you might crash and end up with a hefty repair bill, or worse. In trading, if the market moves against you, it can lead to a margin call, where your broker demands more funds to cover your losses, or they may liquidate your position to protect themselves. So leverage is not just a tool for profit, it's a high-stakes game that requires careful understanding. Now that you see how it works, remember, with great power comes great responsibility. If you found this enlightening, consider subscribing for more insights into how the markets really work. How does leverage actually work, and why can it be so risky? Imagine you want to buy a $10,000 car, but you only have $1,000 saved up. Instead of paying the full price, you find a friend willing to lend you $9,000. This allows you to drive off in that car right away, but here's the catch. You have to pay your friend back, plus interest. In the world of trading, leverage operates on a similar principle. When you use leverage, you're essentially borrowing money from your broker to increase the size of your investment. So if you use 10x leverage, your $1,000 can control a position worth $10,000. This magnifies your exposure to both gains and losses. Let's break it down. If the asset you bought increases in value by 10%, your $10,000 investment would now be worth $11,000. Since you only put in $1,000 of your own money, your profit is $1,000. That's a 100% return on your initial investment. Sounds great, right? But here's the surprising part. The same principle applies in reverse. If that $10,000 asset drops in value by 10%, it's now worth $9,000. You still owe your broker that $9,000 you borrowed. Suddenly, you've lost your entire $1,000 investment. Boom, you're wiped out. This is why leverage can be so dangerous. It amplifies not just your potential profits, but also your potential losses. Understanding this mechanism is crucial for any trader. It's not just about the big gains, it's about knowing the risks involved. So, while leverage can open doors to bigger opportunities, it's essential to approach it with caution. Make sure you truly understand how it works before diving in. If you found this insight helpful, consider subscribing for more clear explanations that make market mechanics easy to understand. Many people believe that leverage is a shortcut to quick profits. It's easy to see why. You borrow a little money, invest it, and suddenly, you're raking in bigger returns. But here's the surprising part. Leverage doesn't just amplify your gains, it magnifies your losses just as much. Imagine you've got a rubber band. When you stretch it, it can snap back with a lot of force, right? That's similar to how leverage works in trading. Let's say you have $1,000 and you use leverage of 10 to 1. This means you're controlling a position worth $10,000. If the market goes up by just 1%, you'd see a $100 gain. Sounds great, but flip that scenario. If the market drops by 1%, you're looking at a $100 loss instead. That's 10% of your initial investment, a big hit. Now here's the kicker. Leverage can turn a small market move into a massive financial impact. A small dip or rise can easily wipe out your entire investment. Most folks don't realize that while they're dreaming of quick profits, they're also walking a tightrope, where a gust of market wind can send them tumbling down. In fact, studies show that many traders who use high leverage end up losing money. The odds are stacked against them, because with each trade, they risk more than just their initial capital. They risk everything they borrowed. So remember, while leveraging can seem like an easy path to profits, it's crucial to understand that the risks are just as amplified. It's not about making quick cash, it's about managing risk wisely. If you grasp this concept, you're already ahead in the game. Don't forget to subscribe for more insights on how markets really work. When you're using leverage, it can feel like you're riding a roller coaster with a thrilling speed boost. But here's the reality. If that ride takes a sudden drop, you could be in for a jarring surprise. This brings us to the concept of a margin call, a vital part of trading on borrowed money that many overlook. So what is a margin call? Imagine you're at a car auction. You spot a shiny vehicle worth $20,000, but you only have $2,000. With leverage, you can borrow the rest, but your broker has a rule. They want to ensure you have enough cash in your account to cover potential losses. Let's say they require you to maintain a minimum balance. For simplicity, let's say it's 20% of the total value of your leveraged investment. Now, if that car's value suddenly drops to $15,000, your equity changes as well. Your initial investment of $2,000 is now just $2,000 out of $15,000. That's only about 13% below the required 20%. This is where the margin call comes in. Your broker contacts you to say, hey, we need you to either add more money to your account or sell some assets to get back above that threshold. And here's the surprising part. If you can't do that quickly, the broker has the right to sell off your assets, possibly at a loss, to cover the loan. This could lead to a downward spiral where you lose more than you initially invested. Understanding margin calls is crucial because they highlight the inherent risk of leveraging investments. It's not just about amplifying gains, it's also about the potential for rapid losses and forced selling. So, while leverage can enhance your buying power, it can quickly turn into a minefield if you're not prepared. Now that we've unpacked margin calls, stay tuned as we explore how to protect yourself from these risks. Vocabulary: leverage, margin call, equity, broker. Imagine you have $1,000 to invest, and you decide to use leverage to amplify your buying power. With a 10-to-1 leverage ratio, you can buy $10,000 worth of stocks, even though you only have $1,000 of your own. Sounds exciting, right? Here's where it gets interesting and risky. Let's say the stock you picked rises by 10%. Your $10,000 investment is now worth $11,000. You've made a $1,000 profit, which, let's not forget, is a 100% return on your initial $1,000 investment. That's a thrilling scenario. But here's the surprising part. The other side of leverage can turn that thrill into a nightmare. Now, consider what happens if the stock drops by 10% instead. Your $10,000 investment is now worth only $9,000. That's a $1,000 loss. But remember, you leveraged your investment. You're still on the hook for the full $10,000 position. When that drop occurs, your initial $1,000 investment is wiped out, resulting in a total loss. In this case, you lose your entire stake. Many people mistakenly think that leverage is just a way to boost returns without realizing the flip side. In reality, while it can magnify gains, it also magnifies losses. You're not just risking your initial investment, you're exposing yourself to the possibility of losing it all. Understanding this balance is crucial. Leverage can be a powerful tool, but without awareness of the dangers, it can lead you straight to a margin call, and that's a place no investor wants to find themselves. Leverage might sound like a golden ticket to enhance your trading returns, but here's the crux. It's a double-edged sword. Imagine you're on a seesaw. When one side goes up, the other goes down. With leverage, you're essentially amplifying both your potential gains and your potential losses. Let's recap. When you use leverage, you're borrowing money to increase your buying power. This can lead to exciting profits if your trade goes well. For instance, if you invest with 2x leverage and your asset appreciates by 10%, you effectively make a 20% return on your initial investment. Sounds thrilling, right? But here's the catch. If the asset drops by just 10%, you double that loss too, resulting in a 20% hit to your investment. And in a worst-case scenario, if your losses exceed the initial investment, you could end up owing money. People often think of leverage as a shortcut to riches, but this mindset overlooks the risk involved. The market can be unpredictable, and what goes up doesn't always come down gracefully. It's not just about how much you can gain. Understanding how much you can lose is equally crucial. So, how do you approach leverage wisely? Start by fully grasping what you're getting into. Consider using lower leverage ratios and ensure you have a solid risk management strategy in place. In summary, leverage can indeed be a powerful tool in your trading arsenal, but it requires a cautious and informed approach. If you found this explanation helpful and want to explore more insights into the world of markets and trading, you know what to do.